everybody. This is hopefully going to be an action-packed hour here. Should go about 50 minutes, and then we'll have some room for Q&A towards the back end. I actually have had a lot of fun putting this together for today, and I apologize if I itch my eyes a lot. It's allergy season for me, so apologize for that. Yeah, so I'm putting this together today. We're going to go about an hour. It'll be recorded. You'll get the slides. You'll get the recording after this. So, and as you get these, encourage you to forward those on to other colleagues that may be able to benefit from what we covered today. So hopefully we'll go big picture, but really get kind of granular on some of the details and nitty gritty within financial aid. So I wanted to start out thinking about, if you guys have seen me talk, just the idea that really, as advisors, we have an opportunity to do more for our clients in the area of college planning, college funding. So what I mean by that is, as we look at the college search process, the college buying process, how do we make informed consumers? Informed consumers oftentimes can come from good advice. So I think what we'll illuminate today through some of the tools and resources we provide, that just by knowing some different layers of this onion, we're talking about tens of thousands of dollars per year. Just by understanding fundamentally how financial aid works differently at different schools and some of the mistakes that we see in reporting, but also just in understanding how the financial aid policies work at these different institutions, there's just this bigger and bigger divergence. So I put up just some different schools up here on the board, but these are some great schools. But if I look at all these schools, I mean, I can tell you things about these schools that just nothing against you or or the student, but you could be paying $40,000 more per year just because of the way they look at your family's resources. So we'll illuminate that as we go. And the other thing, just to understand that this is the rhetoric that's going on at home. If you get in, we'll figure it out. Right. So if you get into that great school, but are there other schools that may be just as good, as high a value for your student, where you could save, 6 figures? And the answer is yes. I'm not just talking state school versus a private school. I'm talking one private school versus another private school. So we'll enter some of that today. And hopefully you're here today because you just want to learn, what are some common things that we see as mistakes, because families left on their own to do these forms, they're going to make a lot of these mistakes. So I'd encourage you to get on board and understand them. So a couple things to tee us up here. We talk about this a lot within our sessions, but the sticker price of college is irrelevant if you know how to shop. So what do we mean by that? Well, merit scholarships and need-based grants they pay for about a third of college, which is awesome. And we also know that the private colleges are discounting their tuition on average over 50%, right? So that's great. But the important thing is to understand is that the averages are often misleading. So when we look at this, we're talking about financial aid. When I talk about averages being misleading, if you go and do a tour at a great university like Georgetown, it's not to pick on Georgetown, they're an amazing university, have great products for their kids. But the cost of attendance there now is over $80,000 a year going into the fall next year. So if you go and you do the tour on campus and say, look, yeah, I know it costs $79,000, but over 50% of kids get financial aid. If you have need, we meet 100%, but we don't have scholarships. Right? So there's no scholarships. So if you're not a need-based financial aid candidate, you'll pay full price. Oh, but wait, the average price here, the average student only pays $28,509. So as a consumer, you get attached to that number. Oh, well, the average student. But what you need to think is, am I the person paying full sticker at $80,000, or am I paying $1? Right? Because the average is, they're not lying. That is the average out-of-pocket cost, the net price. But the key is, what does that mean for us and our family? So as we go through these mistakes, I think what you'll see, these are the kind of things that we can avoid if we understand how to shop smart, if we understand how to file correctly. If you're new to us, College Aid Pro, the whole mission is really, every family has an affordable path to college. They just need they need help figuring out how to get there. So our mission really is, if we can raise the bar on college funding advice across the industry. So we can end the student loan crisis one family at a time. So our mission is to empower advisors with software, training, and community so that you can get good results for your families as you work with them. Every talk I do these days is I like to start with 3 big things that I would like you to take action if you're here to learn, hopefully get some great information. What I mean, take action is one of the three outcomes I want is one, I want you to, get on board, learn this stuff, learn how to give clients better advice in this area for yourself. Number two, if you're more of a seasoned advisor and you've got a junior, this work is phenomenal for the junior advisor to add value in your practice. So have them become your surgeon on your team and go deeper into this. Or number three, if you want to talk to us about outsourcing some of this work and making sure you've got a surgeon that you can call on when you need us, reach out, do a demo. So our demos, which I'll talk about towards the end, it's really more of a discovery call. We're obviously going to talk about software, but everybody that works on our sales team, they're advisors. They've sat in your seat. So we want to learn about your business. We want to learn what you're looking to get out of collegiate Pro and some of the things we do. So hopefully that's helpful just to tee things up, big picture. Won't hit on me too much. So I want to hit on the top filing mistakes that we see out there by families. And then I also want to hit on some kind of misnomers. So we're going to go through the top 5. And I'm also going to be bouncing between slides and collegiate Pro. So number 1 is misreporting of retirement accounts. We'll dig into that. We'll talk about how a lot of times people mistakenly think tax planning and financial aid planning are the same. Hopefully dispel some of those myths. Improperly reporting 529 plan assets. I'll show you with real numbers what that means to a financial aid opportunity. Not understanding the differences in the different methodologies, even down to the school level, the fundamental differences in how schools look at your finances and what they think you can afford. And then number 5, over reporting home equity. So let's hit on those each individually. So number 1, let's go through some fundamentals of blocking and tackling. When we're talking about financial aid predominantly, FAFSA, that's the majority of our schools, use the free application for federal student aid, and that drives a federal formula. And that essentially tells the family what the school thinks you can afford each year. So I put together a little timeline because, it's not necessarily a mistake, but just understand what the timeline is, what they're looking at. So the basics are, if you're going on, let's say you're a senior in high school today. Right, so they're going to be a class of 2022. So college is going to start in the fall of 2022. Right, so right now we are in that application season. So we're applying for admissions, and we're also applying for financial aid. So the admissions process opens up on August 1st, and the financial aid process, the forms open up on October 1st. So August 1st is the launch of the common application, where you can apply to nearly 1,000 schools with one click. And then the FAFSA becomes available October 1st, as does the CSS profile. And the big thing is just high level. We're not going to dig into this today because we're going to focus on these kind of mistakes and the impact they could make. But high level, the assets that they're looking at non-retirement assets. And I'll dig into this a little bit in a couple slides. Non-retirement assets as of the day you file. So we're looking at financial aid forms, and we're going to talk about what is cash and checking and savings, and then what is investments. What they're looking for is as of the day you file. That's what you're actually putting on the form. The tax year that they're looking at is actually the prior tax year. So we're going off to school in 2022. They're looking at our 2020 tax return. The easier way I say to think about that is the spring of the sophomore year and the fall of the junior year of high school. Spring of the sophomore year and the fall of the junior year of high school. So as planners, we're planning for the future. The need to do college planning and this late stage college planning really begins that freshman year of high school. If we're going to make any impact and move the needle on any financial aid we may receive, it's really got to begin that freshman year of high school because those are, if we want to maneuver anything, these are the years. So another thing, like big picture, as we look at financial aid and planning to get as much as we can out of the system, this is the one time in your life you want to look as poor as possible. I'll say that again. This is the one time in your life you want to look as poor as possible. And that's when you're applying for financial aid. So we'll hit on some of those kind of key areas where you can make a difference. Just hopefully this is just helpful, FAFSA, big picture. This is what we're looking at. So when we look at misreporting retirement accounts, right? So this one, as we round these out. So if we look at just misreporting retirement accounts, IRAs, 401ks, 403bs. So real life story, just about a month ago, actually had a certified financial planner book in a discovery call to talk about his financial aid opportunities. So I sent them a self-discovery link, which you can do through collegiate Pro, and I said, just go through, do some general onboarding, and we'll have a conversation, when we get on our Zoom call. So this particular individual, I got on the call, and they had in this bucket here, they had $1.2 million sitting in their net worth of investments. So if you look at these up here, this is the EFCs that are produced out of the system. So that 1.2 million, yeah, that's going to make a difference in what they think you can afford. So I simply said, what makes up this 1.2 million? And lo and behold, they didn't read the instructions we have here because they put in their retirement accounts, right? So this should only be non-retirement, CDs, stocks, bonds, mutual funds, 529s. But even a certified financial planner, when they read net worth of investments, they put it all in there. So don't assume that your clients know what to put in that bucket, because that right there just cost them $60,000 in financial aid for that year. So, if you move this back down to, let's call it 100,000, well, now we're back down here, right? So again, don't assume, because your 401k and 403b, we have it as an input, right? But it's not going to impact your EFCs at all, right? So that's just the key here. Like on our input forms, yes, we have it. We have it so that we can account for them, but it does not impact your EFCs at all, right? So as we're in the system here too, I should give a little brief overview just to understand. This is the collegiate Pro Advisor workstation. I utilize it not because I'm trying to do a whole demo and a sales pitch, but what we've built allows us to demonstrate all these concepts very easily, automatically calculating EFCs at all three different types of schools. Even within each of these private schools, there's different pieces of the puzzle. So hopefully that's helpful. Don't put your retirement assets in there as a net worth of investments. So again, CFPs themselves have done it. So that's number one, because when we look at what's assessable and what's not, it's over here on the left. It's cash, it's 529s. Cover those mutual funds, bonds, and equity in real estate. But your home equity is not included on the FAFSA, right? So your home equity is not included on the FAFSA. If you have a small business, that asset is not included on the FAFSA. So those are key things to point out in the process. And we'll come back to overstating equity I'll give us some examples there. But just to understand, what is accessible, what's not. Your IRAs, your 401ks, and pensions are not. All of your non-retirements assets are. And so one thing I'll point out here, 529 plans, we've got another example of helping you understand why you don't want to misreport. But on 529 plans, they're asking, what 529 plans do you own for all of your children? Because if you own it, that's an asset of yours. So if you've got 25,000 for each kid and you've got 3 kids, the number is 75,000 that goes on the financial aid forms as one of your investments. So that's a common one because they know they wrapped this up years ago. They know we can change the beneficiary whenever we want. So that's one piece. Like I said, just that idea of misreporting your retirement assets is probably the first big mistake we've seen. And then once you put it in, it can't be unseen by the financial aid office. So mistake number 2 we see all the time is just this idea of that tax planning and financial aid planning are exactly, they're the same. They use a lot of the same terms, they collect the same information, but the way that they benefit you or don't benefit you can be very different. So what do I mean by that? So a lot of people say, well, a common misconception is whoever claims the student on their taxes has to fill out the financial aid forms. So in a divorce situation where we're trying to plan for who claims the dependent, that's oftentimes decided within the divorce decree, and it's an alternating year. It does not matter who claims them as a dependent as far as who fills out the financial aid forms. The financial aid forms are filled out by the custodial parent, and that is the individual that they live with the majority of the time, 51% of the time. So that is who should fill that out. It does not matter who claims them as a dependent. So that's one common misconception that we hear. And then another one is when you look at the financial aid formulas, it's very much geared towards income, which is absolutely true. So one of the temptations is, oh well, especially from a consumer, is, well, we'll just go max out our retirement plans at work, and that'll drive down our income. we'll pay less taxes and it'll be great. But on the financial aid forms, they're actually going to ask you, what did you put into retirement plans? And they're going to back that right out. So going back into this sample case here for Kelly as the student, if you look at the parents' income now, and you look at, just this 150,000, AGI 150,000. So some of the things that will come in here is if you have untaxed income, they're going to ask, what did you pay into tax deferred pension programs? And we'll even show you where to get that from your tax returns. And if you say, look, we put in 20,000 collectively into our retirement plans, and so you can see, watch these up here, what this does. So they're going to say, we're going to add that back in, essentially is what happens. So it doesn't, from a tax standpoint, great, fantastic, deferral, all the stuff, but from a financial aid standpoint, it's neutral. So putting money into retirement plans is a neutral proposition because they ask how much you put into your pre-tax plans. So just something to, hopefully that's helpful. It doesn't help or hurt you from a financial aid planning standpoint, but it does hit right there. So the other one I was going to put on here is income tax paid. So let's say this 150,000. Let's say they paid $12,000 into income tax that they paid in. That actually does help you. So they let you say, what did you pay in taxes? We're going to consider it like you didn't make that money. And then on this untaxed income buckets, pre-tax retirement contributions, that just gets added right back into the formula. So hopefully those are helpful, just kind of the order of operations and understanding. One of the mistakes, again, that we see is that we think tax planning is the same as financial aid planning, and they're very different. In many cases, those are just a couple common ways that we see that, people may think, you want to think twice about it. So, and again, that's one of those things you need to help families that you're working with on these financial aid forms. This stuff's confusing for our financial professionals, let alone the families, and let alone the kids, the students, right? So that's there. So we'll move on. Let's see, to number 3, reporting 529 plan assets as a student asset. So a couple things to note here. On the Fafsa, they're actually going to ask you for cash and savings, and they also ask you for net worth of investments. 529 plans, as I talked about before, they're asking for 529 plan assets that you own for anyone in your family. And on the financial aid forms, sometimes the confusion from a parent would be, oh, we've got this 529 for Kelly, so we have $50,000 saved up, and that's Kelly's asset. So what happens is sometimes if a parent were to come in and say, oh, so that's Kelly's asset, and let's say there was $50,000 there, look at what this does to these EFCs. It's going to bump that up significantly, right? So that's a big jump, right? So, but what if to report that appropriately, it actually would go as a parent asset under net worth of investments. So if we put 150 here, that's 50,000 more than we had. It's going to bump that by about a couple $1,000, right? Well, why is that? Right, and that's because the way that the FAFSA formula works. So misreporting, again, as a student asset, that's going to cost you, because they want 20% if it's a student's asset. They want roughly 5% if it's a parent asset. So again, that swing right there for that family, that would be $8,000 to $9,000 of financial aid they just left on the table, simply because they filled out the form incorrectly. Right, so these are your families, that you're working with. If you're not assisting them with filling out financial aid forms, helping them understand their balance sheet and what goes where, that is the impact that could make. So over 4 years, that $8,000, that could cost them, tens of thousands of dollars in financial aid. And I see it all the time. The parent just thinks, oh, that's the 529, that's for Kelly, we're going to put it in here as her asset. And on the FAFSA, it actually doesn't matter who owns the 529. It can be the parent or the student actually that own it. It still goes in the parent asset bucket. Is that confusing? Yes. And that's why we're here today. These things are confusing, and hopefully this is helping you add value to your clients if you could assist them with filling out these financial aid forms. Because again, as you can see, that's thousands and thousands of dollars that you leave on the table with financial aid if you report that incorrectly. So we got that there. So Not mistake number 5. It's a mistake, and it's just kind of some misnomers and hopefully some education for you all. And that is just understanding the key differences in the federal method and the institutional method. So where the plot thickens is you have an additional form that's required. So in assisting families, understand that most schools are going to require the FAFSA. I mean, 99% of schools require the FAFSA. There's only a couple off the top of my head that don't. But any school that takes federal money, they're going to have you submit the FAFSA, because that's how they're going to have the ability to give you federal financial aid. So they're using the federal formula. Other schools, in addition to the FAFSA, I say that's not either or, it's and, right? So you fill out the FAFSA as well as the CSS profile. And in some cases, there may even be an institutional form. So one that jumps out, is a school like Princeton, some of the Ivies. So what those do is they dig much deeper into your finances. They ask about the last year, they ask about current year, they ask about future years. They ask, do you go into private school? Because they'll give you a little credit if you're attending private school and paying for that now. So there's a number of different things, and the differences in the formulas and just fundamentally how they run their businesses. But I like to point out just kind of 3 key ones that we see all the time. But here's kind of some of the big ones. So the one here in the middle, though, the small business and farm, the FAFSA only counts a business if it's 100 employees or more. So that's the only way you report your small business as an asset, is if you have 100 employees or more. Whereas on the CSS profile and the consensus, they are going to ask, what's the value of your business? So that can be a whole webinar itself, is how do you actually calculate the value of your business? One of the things, as the CSS profile asks questions, they're fairly pointed, even to the point where they are asking for non-qualified annuities. A lot of the schools are even asking for your retirement account balances now. So on the form, they're going to ask for your retirement account balances, and I've been assured that they're not going to assess those for financial aid. So I said, why do you need them? They said, well, we don't. I said, so do I need to put them on there even if they've got $10 million? They said, no. I said, so why are you asking that on your form? Well, we just like to have a full picture, your financial picture. So this whole thing for me, it gets into they're not being transparent about how they actually assess you. So we are left to go out and try to figure this out and decipher this. And this is where we have cracked the code. We do have folks that work within financial aid offices help us decipher what actually goes into who gets what money. So there's just so much going on behind the scenes, and home equity is a big one. We see it with lots of families. Assets in a student's name is another, and then divorce situation is another. These are 3 things we see all the time. So let's hit on home equity first. The FAFSA does not ask about home equity. They don't ask about debt at all. Whereas the CSS profile, they go pretty deep. They want to understand, what's what, and then also, the consensus schools as well. So the CSS profile, the institutional method, consensus method, these are 2 different methodologies that are used. And I say it varies because, as you'll see within the system, home equity, the way it's reported, is the way that they assess home equity is wildly different. And then divorce situations, the FAFSA only counts the one parent's income and assets, whereas it varies on the CSS profile that use the institutional. And the consensus method, they are all going to ask for both the custodial parent and the non-custodial parent, so both of the birth parents. There's a whole nother presentation on who fills out what on the forms, but the big thing is just understanding fundamentally at a high level, these are big swings depending on where things sit for a particular family. So I wanted to just show, I think, about that. And over-reporting home equity is the 5th one. So I'm going to go through some specific cases. So let's talk about over-reporting home equity, and then I'm going to show you kind of the fundamental differences in how schools look at home equity. So I'm actually going to go to a different case here real quick. Let's see. So this AL home equity here. So just put together something that hopefully can help illuminate what's going on with home equity at different schools. So thing number 1 is overstating home equity. and equity in any of your properties, like if you got a rental or vacation. Because right now, if you go to Zillow and you looked and you said, oh, most people go and they say, what's your home equity? Say, well, Zillow says it's worth, $1 million. We owe 300,000. So therefore, our home equity, we have 700,000. Right. So, in that scenario, so that actually, if you see this up here, I'm going to zero this out real quick so you can see what happens. So look at the numbers at the top. When I zero that out, what happens? This one doesn't change at all. These change dramatically, right? So because these schools are going to look at home equity and they're going to look at it different ways, school by school, not even just general within the methods. I'll show you that here in a second. So this 700,000, I'm going to plug that back in. So overstating home equity. That case I just gave you, one of the things that has been tried and true is you can actually use a fast asset sale rule to say, hey, if you want money from this within the next year, then I get to use a 20% discount, right? That's a fast sale rule. You probably haven't thought about that since the Series 65 you took 10 years ago. But that fast sale rule, whatever the value of that asset, if the market says it's worth $1 million, I can tell you it's worth 800,000. So instead of showing, in this case, 700,000, I can reduce that home equity by $200,000, right? So if we did that in this particular case, we said, look, my home equity went from 700 down to 500,000. That's going to drop these significantly. $10,000 difference at these type of schools. $10,000 difference per year just by overstating home equity. And where this really hits people is on the coast, right? So home equity on the coast is a big deal because there's certain schools that have come out and said, look, we're not going to count home equity anymore because we know just because you have a house that's worth $1 million, it doesn't make you rich in Southern California. It doesn't make you rich in Boston. That's just, houses have gone crazy. If you're in the Bay Area, that's a fixer upper, right? So some schools have gotten wise to that. One of the things about the formulas is they don't care where you live, right? So if you're making 40% more because you live in New York instead of Cedar Rapids, Iowa, they don't care. The formulas are the same, right? So there is no based on zip code or anything like that. So just understand that the formulas just don't care. They're just trying to create a level playing field for everybody across the country. So congratulations if you live in one of those places, but they don't really care within the formulas. So hopefully that's helpful on, don't overstate home equity. And again, the mindset, this is when you want to look as poor as possible, right? The only people getting this are the forms that you submit. So just understand this is when you want to look as poor as possible. So keep your home equity as low as possible. So that fast sale rule from an asset, like what's it worth standpoint, that's definitely a very tried and true method. And the other thing you can go do is look at your tax auditor's website, right? So it's another thing we can do is look at a tax auditor's website and see what they value your home at versus what your mortgage is. That's going to be a lot lower than Zillow, especially today. We have markets up over 40 and 50% in the last 12 months, and that's great on your balance sheet. But for financial aid, show as little as possible. That's the idea there, especially because it's these private schools that are looking at that. But to go a step further with home equity. So I'm gonna come back to questions here in a second. I appreciate them coming in, and we will have plenty of time. So I appreciate them coming in. I wanted to show, actually, I'll take them real quick before I dive into showing the differences in home equity and what we've put together inside of the system. So a couple questions came in on like income tax paid. So most of the what's on the financial, or I'm sorry, the data retrieval tool is going to show you, it's going to pull in information from the IRS. So when you go to fill out the FAFSA, there's a point where it comes to where you're reporting your income, and it actually says, would you like to link up with the IRS and have us pull in the information that we need through our data retrieval tool? For 90% of people, that's going to work. I don't know if that's the correct number, but for most people, that is going to work to be able to use that data retrieval tool, and that makes the process a lot easier. And it's going to pull everything right into the appropriate bucket. But when you go through, it actually is going to tell you, income tax paid, what about self-employment tax, what if I'm self-employed? It's going to tell you which lines in the 1040 that you're going to pull that from. There's a little question mark that sits there inside of the FAFSA. So, when you talk about income tax paid, and I'll even show you like within our tool, if we go to parent income, So, we're going to look at, untaxed income, what goes in there, pre-tax, IRA deductions, tax exempt interest, all these different pieces of the puzzle are going to be in there for us. And then if you have questions on them, there's always going to be a note. What's an untaxed distribution? What about pre-tax retirement plans, income tax paid? This is where you're going to pull that from. So, for us, it's always line by line. It kind of lines up exactly with FAFSA. So that's it. Another question came in from Janice. Do IRA assets count for the student? No, IRA assets. So one of the strategies a lot of times that's being utilized is if a student works, put the money in a Roth IRA. All right. So for lots of reasons, but putting those dollars in there so they will not show up as an asset. When you take distributions from IRAs, it will show up in the following year as income, right? Even if it's tax-free, it's still going to show up. You still have to report some of that. So when they look at it from a financial aid standpoint, so a lot kind of wrapped up in that question, but the short answer, assets don't count for the student. Let's see. So let me hit a few of these questions. Clifton asked, what do you do if divorced parents are sharing custody 50-50? So in that case where it's true 50-50, as long as they live in the same school district, especially, it's whoever they live with the majority of the time. But to put yourself, whenever you're doing something where you want to put your best foot forward in terms of getting the most financial aid, I would have them live with the less financially successful person one more day that year. That's what I would do. I'd have them live with a less financially successful person one more day that year. That is the parent that fills out the financial aid forms and therefore hopefully gets the most financial aid if they qualify. So if I make $70,000 and I'm a teacher and my ex-wife makes $450 as a surgeon, I'd rather have them look at my income as opposed to my ex-spouse's information. So that's that. How do you report 529 that the grandparents set up? So that's a great question. If you look at some of our slides we had up here somewhere, we had, I thought I had what's reported and what's not. 529 grandparent assets aren't looked at, right? So when you put down what asset, grandparent asset is not reported. So 529 is owned for the benefit of the student. It's not reported. However, 529 plans coming in and being paid to the school. So if we had let's say there's $10,000, we didn't report that as a resource that we have on our financial aid forms. If $10,000 were to come into the school, they would count that as an untaxed income, 50% to the student for the following year. So $10,000 could disrupt the next year's financial aid by up to $5,000. So the way around that is to use grandparent 529 assets for the junior and senior year of college because of the prior tax year rule, right? So that the income by the time of the junior year, because they're using 2 years prior, by junior and senior year, those income tax years have already passed. So that's kind of from a planning technique standpoint, that's it. The proposed FAFSA changes, which we're going to have a ton of stuff on, really as they get solidified, the proposed FAFSA changes and financial aid formula changes basically are saying that the grandparent, even if money comes in, it doesn't matter. They're not going to have it hurt you from a financial aid perspective. So a lot of planning opportunities there, assuming people trust their parents to put 529 accumulate there, because anybody can contribute to a 529 and there's always one owner and one beneficiary, and even the beneficiary can be changed. They're extremely flexible vehicles. So a lot of planning opportunities coming up with grandparents and 529 plans, especially. Presentation will come out and we'll record this as well. So yeah, the question, I kind of went down a rabbit hole about, do you report retirement assets on the CSS profile or not? I have not been, because I've asked specifically to a school, why do you need this? You can't unsee it once I put $1.5 million in there, right? Do you need this or not? Is it required? No. Okay, so understand on the CSS profile, there are questions, some of them are required and some of them not. So, just having those specific conversations, because I just say it just really bugs me, this whole system. And that's why I'm here, and that's why we're trying to advocate for clients to get the most they can on the financial aid system. So, whenever, we get worried about that, just understand how intentionally opaque this process is, right? Until people started coming along and fighting back, and we can all push back as an industry, you got consumers out there going into the meat grinder that is higher education. They're going up against higher ed, they're going up against Wall Street, and they're going up against the federal government that gives out all the loans. So for us to advocate and get the most out of the system, we're left to ourselves. So giving great advice in this area can add a ton of value for our clients and for our young people trying to get a great outcome from college. Home equity, can you take 20% off the tax value? No, I mean, that would be a tough one, Ryan. I think it's really either or. So I would say it's 20% of like what current fair market value would be. Filing fees for the CSS profile. I don't know that it's up to 100,000 now. It might be what it is. As far as just the question is there a filing fee? And the answer is yes, there is a CSS profile to file per school. But I'm not sure honestly what the income limit is. It might be 100,000 now. I thought it used to be lower. Are we getting the slides? Or are they client approved? They're my slides. That'd be for you and your compliance department to decide what's approved. But everything that we do is copywritten, so we'd prefer not to see it unless you have express written permission to utilize it. When you're on the forms, John, you can see if a question is required or not. It's going to have an asterisk by it. Questions coming in from David, like how do the colleges verify any cash gifts from relatives? Do they go through checking accounts? There's a lot on the honor system here, with what we do and how you report things on your assets and your income. But if you get pulled for verification, that's where they may look further. As far as digging into your actual checking accounts and incomes and outflows, I've never really seen it. And they're going to ask you to give them your assets, maybe ask for a tax transcript, those kind of things. But you're exactly right. Like equating for cash gifts, like pretty hard for them ever to track that down. So, okay, so hopefully those are good. So I got a little more content to get through. So thank you guys for all the Q&A, and we'll come back and hit some more at the end. So we got about 20 more minutes, and there are a few things I wanted to hit on. We talked about the impact of home equity, obviously. So in this case, we've got a fairly middle-class family making about 150,000, 140, 135. You got the income tax, so they're a fairly typical family. When we look at the asset, their big asset's the home equity, right? So understanding that these schools aren't going to look at it, these ones will. These schools can make a big difference. But we've even gotten to the level within Collegiate Pro now that we understand which schools assess home equity at what rate. So what the heck do I mean by that? Well, I'll tee this up like this. If we look at the cost of attendance, now they're alphabetical, but if we look at the cost of attendance of these schools, and we're ranking them from lowest to highest, they're going from 70,000 to 85,000. Right, it's a pretty big difference. These are all private universities that are out there. The key is what we want to understand is the net cost. Right, so look at this. These differences. This list just got completely scrambled. So the cost is here. This is our net cost. What is going on that's making Boston College $35,000 more than Princeton? Same with Northwestern. Why are these so high? What about these ones in the middle? What's going on? So within the system, we're actually going to help you understand what EFC methodology they use. These IFC over here. And then there's 1, 2, 3s. So we're actually going to even help you understand, do they use a modified EFC? So this is super nerd level college planning, but all this is available to you at this click of a button because we've built it into Collegiate Pro now. Because we're trying to crack the code to help every advisor out there find the great schools that are going to be the least cost for their family. So, if we go through these and we just go through and I want to sort these by net cost. So I look at Princeton and I look at Harvard. They both think we can afford $28,000 a year. So does Stanford. Well, why is that? It's because these schools have all decided that they're not going to count home equity against us. Right? Whereas opposed to these schools on the bottom, Well, guess what? Northwestern and Boston College, 100% of your home equity, they're going to count against you at 5% as an asset. Nothing to do with you. It's just how they run their business. Nothing to do with you. It's just how they run their business. Where else can you add value at that level, though, for a client? You're looking at a school, Harvard, Stanford, and then you got these schools in the middle. They're going to assess some home equity, but not all of it. But these ones, they are going to do it. And this one, they use a federal method. So, how do you break through all this noise? I don't think you're sacrificing quality to go to Harvard or Stanford, any of these other schools out there, right? And that's just, that's just how they're running their business. So, our out-of-pocket cost goes down. And simply because of that. So if you can get into schools like Northwestern and Boston College, and you have high home equity, well, you might want to consider, if that's a big asset for you, you might want to consider some of these schools that aren't looking at home equity, right? So that's a big difference. That's $30,000 plus per year for this family. That's $120,000 to $130,000 over 4 years. That's simply by knowing how the financial aid policies of that institution work. So when we talk about where can you add value, you want to talk about alpha, beta, Sharpe ratios. Well, 120 grand over 4 years, just by knowing which school runs their business one way over another, I think there's quite a bit of value there. Like within the system, like we're going to help understand too, like there's other layers of the onion here. Like, okay, so Princeton, they're using what method? They kind of use a proprietary method to get to where they're going. But they don't count home equity. Harvard, what are they doing? Well, they cost $84,000. They use this method. They meet 100% of need. No scholarships. No scholarships at all. So we're getting into, this is the schools we're looking at on a side-by-side basis. We look at these different schools and how they run their business. Allegheny, small private. Look, their average non-need merit scholarships over $33,000. Right. So student-specific stuff. We're understanding like the average student here gets at least $33,000. It's just one school over another. Just kind of how they run their business can be very different. Schools, small privates like this one in Collegeville, Pennsylvania. We're able to show you, you've got a semi-automatic scholarship of $32,500. Right. So, financial aid policies of schools and the differences between them, getting granular on what that means. Ultimately, what it leads to is helping people understand when you have a sophomore or a junior, is understanding like what's our funding gap. If we've established what they think we can afford, we've established a budget, we can now go and shop smart. And now we understand, look, these schools actually, these are going to be our most affordable options, even though some of these other schools don't cost as much. We're not sacrificing quality by considering schools like Princeton and Harvard and Stanford versus Boston College for this family that has home equity. It's simply the way they run their business. So, that is what's at stake here. I think by not helping families through this process. So hopefully that's helpful. Just kind of give you some insights into, the collegiate pro system and kind of how level detailed it can get. So I'm going to run through a few more slides. We got through really our top 5, misreporting retirement accounts, the difference between tax and financial aid planning, 529 assets in a student's name, big mistake there. And then the key differences in the federal and the institutional method. It's a big deal. So the other thing I wanted to talk about is the biggest mistake of all. So we went through the top 5, but the biggest mistake of all is not filling out the forms in the first place. And it can cost you. To wrap this up, so there's a lot that kind of rolls up in here. So those are the top 5 like filing mistakes, but the number one thing is not filling out the forms at all. One of the challenges that exists, the estimates are 67% of low-income students did not submit their financial aid forms last year. 67%. And these are students that could stand to get the most out of it. It's confusing. There's a lot going on. A lot of times can't get parents to report. So, but for all families, the big thing is don't assume you're not going to get financial aid. Right? So I don't assume you're not going to get financial aid because they're going to look at what's accessible. And I put this in here from an income standpoint. A lot of families assume they're not going to get this financial aid. But if you look at where income is at now today, this is just a quick kind of example of they want about 20 to 25% of your income. And a lot of times we even heard, people come in the office and say, well, our financial advisor said we're not going to get financial aid. Okay, well, let's talk about that. How much money you make? 150,000. Cool. They think you can afford $32,000 worth of from your income this year, right? And then what about these assets up here? Well, we've got about 100,000. Cool. So we're up to about a $35,000 to $40,000 EFC. What schools are you looking at? We're looking at MIT and USC and Northwestern. Cool. Well, those schools, this is how that works. You're going to be eligible for $40,000 of financial aid. Why is that? Well, cost of attendance minus your EFC, that's your need, right? So if a cool school costs 50 and your EFC was 20, you'd have $30,000 in need-based aid eligibility. If a school costs 80 and your EFC is 40, you still have $40,000 in need-based aid eligibility. So don't rule yourself out of need-based financial aid until you're sure. Run the numbers, get the analysis done. So for us, we talk about, our free college money report.com. It's going to give you your EFC and all three methodologies. It's also going to show you your net cost of 3 schools side by side, what you'll get in form of scholarships or need-based aid. So if you want a quick EFC calculator, go to freecollegemoney.report.com. It'll give you all 3, and it'll also give you 3 schools side by side. So people used to say, like, when are you ruled out of financial aid? I said, well, there's assets and there's income, but it used to be, income is the highest driver. And I used to say, once you make about over, 225, 250, you're not going to get any financial aid. Whereas these days, schools still have programs where if you make 250,000 or less, you're still going to get upwards of $25,000 to $30,000 off the sticker price, even at a $225,000 income, right? Because of those formulas. So it's a moving target. It's not one size fits all. It's school by school. And as we've shown, just the way that they calculate your EFC alone can have a big swing, especially with home equity these days. So don't rule yourself out of need-based financial aid until you're positive, because we see that a lot of times. People just think they won't qualify. So the number 2 thing, like when people don't fill them out, they're going like, well, we're not going to be need-based financial aid candidates, so we're just not going to fill out the forms. I don't want to give up all that information. Well, many schools, to even be qualified for merit scholarship, you still have to fill out financial aid forms, because they're saying, hey, if we have money, do you want it? And if you do, you have to fill out the financial aid forms, even if it's for merit scholarship. So that's not true across the board. Many schools, the private schools, many of them do not require your financial aid forms to be filed to get merit scholarship, but make sure that that's the case if you're looking at school by school. So that's another big reason that you want to fill out the forms for even people that won't get need-based financial aid. You got to oftentimes have to fill them out to get merit scholarship money. Another big reason is if you would like access to the federal direct student loan program, which is the best loans you can get for college, you do need to fill out the Fafsa. So you have to fill out the Fafsa to be eligible for the federal direct student loan. It's a federal program. It's dispensed by them. So if you want access to that federal direct student loan, that's another reason you might want to consider it. So hopefully that's helpful. And then the last one is circumstances change. So from year to year, whereas one year you may not have been, the next year you may be need it. Things change even within 1 year. So concrete example is a spouse passing away, middle of the fall semester. Not a great situation. But because we filed financial aid forms, we had them on file. We weren't eligible for any need-based aid. We did utilize the direct student loan program because we do that pretty much with every client. But in this case, father was the breadwinner. That income went away. We were able to go back to that school, and they were able to say, what do you need? We've got this on file. We know what your father made. Let's try and make you whole for the rest of the school year. So what that resulted in was $8,000 for the first semester and $12,000 for the spring semester. If we had not had those forms on file, this is a pretty affluent family, that the financial aid administrator at that school went to bat for us because we had those forms on file, and they knew that the breadwinner, those dollars had been lost. So, but without that, we wouldn't have had a leg to stand on. It would have taken us months and months and months. They turned that around in the course of a couple of weeks to get more money in that family's hands. So that's a big one. And then the other one, it's a little less traumatic. I get a little emotional about that one because it's a real case, but we're able to go to bat, get that money for that family. But a much more common one is that you're going to have overlapping students. So, so if you have a senior and a junior in high school, well, they're going to have 3 years of overlap at college as well. So when we look at this EFC being split, so you're towards the middle of the screen, your federal schools are going to say that $20,000 we think you can afford, that's a family contribution. So when you have two, it's $10,000 each. So if you're at a school that meets 100% of need, that like all the Ivies and some of our top universities, those top schools that meet a high percentage of need, they're going to give you more free money in years 2, 3, 4. But if you didn't fill out your financial aid forms in year 1, good luck. So you have to fill them out. The recommendation is from financial administrators, look, we're trying to package up and understand what we're looking at here. So if you're going to want financial aid at all throughout all 4 years, fill out those financial aid forms in year 1. So, because once you've got those years 2, 3, and 4, it's not guaranteed. If you have to make sure you fill them out even in that first year. And think about that. If you've got a school that costs $80,000 for year 1, but then it's only $50,000 or $60,000 for years 2, 3, 4, that's a huge swing in the out-of-pocket cost for that family to go to that prestigious university. It's a big deal, and that can bring a dream school into play if that's the case. So a lot of the things I talked about today and the mistakes that we're seeing, there's a lot that's up in the air. So on this page alone, the proposed Fafsa changes, like I said, we're going to be doing a lot of communication around strategy and things we need to be aware of. But the big thing is they're going to go from what's called the EFC back to the student aid index. We haven't changed the financial aid system really this dramatically in 60 years. So the student aid index, one of the big changes is being proposed is that they're going to take away this split. So 20,000, if that's what they think you can afford, it's 20,000. It's a student aid index. It's 20,000 for student 1, 20,000 for student 2. So not 20,000, it's 40,000 now. If you've got 2 kids in school, you're expected to be able to afford. So we take issue with that. So much so, in fact, that one of our co-founders, Matt Carpenter, started a petition that I think has over 55,000 signatures now, because we think that that's a rule that should not be included in the new rule, the actual official rules that come out for the 23-24 school season. So academic year, that is. So, so there's a lot of pending changes, and we're going to be on top of those. But what we're going to see, our estimates are that we're going to see a bigger and bigger divergence of schools using the different methodologies, schools using institutional methods. That means the institutions do what they want with the financial information you give them. So, they have a lot more flexibility to dole out their money. The FAFSA and filling out that's really to qualify for the federal student aid, and many schools use that to qualify for any of their institutional money. But for the most part, these high endowment, wealthy schools, they have dollars, and then they're going to figure out what's the best way to dole those dollars out, and they're going to use their own methodologies to figure that out. So, things will continue to have a bigger divergence. Some of these things that we talked about today, just this, you're telling me that one school looks at home equity and another one doesn't. Yes. So if you're a family that has high home equity, that's a big one we see. I showed you the huge swings just by one great institution over another. Divorce situations, right? So understanding which schools look at 1 versus 2. And I mean, there's a lot of opportunities to really do better shopping, because this isn't when you get the financial aid award packages back. That's not when you want to go shopping for school. You want to shop when you have kids that are freshmen, sophomore, juniors. That gives you runway to go find schools you may want to apply to that are going to be a great fit for you. So, but without doing some of this pre-work and not having the underlying knowledge, you're leaving a lot of money on the table. So I'm going to stop the share here. Let's see if I've got some Q&A and stuff in the chat. So I got about 5 minutes. I'll take a few Q&A and then we'll get out of here. Let's see. Yeah, recording's coming. And apologize if there's anything miscommunicated. Let's see. Can a person amend a FAFSA if they filed something out incorrectly? Yes, you can amend a FAFSA. You can go back in. When you go in, you create a passcode, and then you can go back and amend. And then that amended information should go directly to the schools. Depending on what that scenario is, I would definitely make sure to communicate with the actual school to make sure that they have the amended financial aid forms. Like if you make that big mistake on, reporting a 529 as a student asset, that's a big one. Go back, amend that return, submit that, and then make sure that the school you're really interested in gets that appropriate information. If the parent owns a building in which the office of his business is located, can the building's Zillow value be reduced by 20%? So yeah, so it really any property that's out there, I would use that kind of 20% reduction as a fair market value. So whatever that is, take it for what it's worth. That building's worth $1 million, according to some type of assessment. Drop it by 20%, and then that is your value, and then you reduce any mortgage from there. Question is, where do you typically report trust fund assets? Hey, Dorinda. Typically, they're going to be, it's typically for a student, so those usually go as a student asset. Are there ways to maneuver around that? Possibly, but it's really difficult the way that they've tied things up to, if it's a true trust for the benefit of that young adult, an education trust or whatever they are. For the most part, they are going to need to get reported as a student asset. Like I said, we could spend 3 hours debating like how to get around some of those, but for the most part, those get are listed as a student asset if they're for their benefit. Most important return is AGI. To reduce AGI or 401k is a good option. However, IRA 401k will be untaxed income. So the conclusion is the IRA 401k contribution won't really help with financial aid. That's correct. So that is kind of, yeah, it's kind of neutral. Like our colleague Ross Riskin runs the CCFC designation. If you haven't checked it out, I'd recommend you do the AICCFC. I believe it's .org. But we were actually talking about doing a particular session on the difference between adjusted gross income, earned income, and what you want to drive there. So a little beyond the scope today. The point I was trying to make today was just that those contributions to those elective deferral pre-tax plans, they don't help or hurt you from a financial aid standpoint. I think I hit that one. Yep, so I think I hit all of those. And I got a couple here sitting in Q&A. Slides are coming. Yep, we got all that out. I know there are things that can trigger an IRS audit. Are there some things that can trigger a CSS or FAFSA verification request? The most common verification request for the FAFSA is when you're qualifying for Pell. So if you're Pell eligible, that's actually the most common reason that they're going to pull. So if you're qualifying to get federal grant money, that's when they're usually oftentimes pulling for verification. The other thing is if things just kind of don't line up. So like if you were self-reporting income, you put in 200,000 of earned income and like 50,000 of AGI, like they probably, if something's weird, those are some of the flags that might go off. But oftentimes is if you're qualifying for significant grant money, that's usually who gets audited. If families don't apply for financial aid the first year, but want to apply for it the following year, how do schools view that? The school's going to look at that. You need to submit the forms each year, but if you hadn't filed in the past and now you file again, unless something really changed as far as employment or something of that regard, that really changed your situation, they're probably not going to give you a whole lot of new need-based financial aid. But it just depends on the school a little bit. So, but again, like if you want to be eligible for the most need-based financial aid, fill it out from your freshman year on. If they don't give you any, kind of who cares? Are inherited IRAs includable? No. The income from them would be like if you have a inherited IRA R&D, obviously that's going to hit your income, but the asset, no. The asset of the inherited IRA is not included as an asset. So, yeah. So I mean, hopefully this was helpful. Just to understand some of the top filing mistakes. And again, I just wanted to hit on, the to wrap things up, to hit on, these 5 things, these top 5 filing mistakes. I hope that's helpful. And hopefully you got a chance to see a little bit behind the curtain what goes on with collegiate Pro, a little bit of the engine behind it. And I think for today, what we're offering is a free month of collegiate Pro. So if you're not already on the platform, if you sign up for a demo by the end of the month, by Halloween, basically, you will be eligible to get a free month of CAP. So again, hopefully that's helpful. And if anybody is curious about what we're doing, how we're doing it, encourage you to book in a demo with our team. But yeah, there's you're eligible for a month free. Sign up for a demo by October 31st. So we're at the top of the hour. So hopefully this has been a powerful session for you guys. I appreciate everybody tuning in. Let us know at collegiate Pro. Let us know how we can be a resource. And you're going to see a lot of things. I'll close with this. With collegiate Pro, we're going to be launching a whole line, geared towards the consumer. So we're very excited about it. We want to get out and serve the underserved. So we've created free and low cost solutions. So your ideas and your efforts, if you've got pro bono efforts, tremendous way to do that. Ask us how you can partner in your local community. We'd love to talk to you. So again, look forward to talking to everybody soon, and let us know how we can be a resource.